In the mid-2000s, the financial world was drunk on optimism. Housing prices had risen for years, credit was cheap, and the belief that real estate could never fall became a kind of religion. Banks, hedge funds, and investors across the globe were making money hand over fist by betting on one thing: the endless rise of home values. But somewhere, in a quiet office in California, one man was poring over the numbers, and what he saw didn't make sense. That man was Michael Burry. Before he became the man who predicted one of the largest financial collapses in history, Burry was a medical doctor with an unusual obsession: numbers. Late at night, after long hospital shifts, he would study financial statements and post his investment analyses on internet forums. His insights caught the attention of major investors, and soon after, he left medicine to start his own hedge fund, Scion Capital. From the beginning, Burry's approach was different. He wasn't interested in following market trends or listening to talking heads on television. He focused instead on deep, fundamental research. He believed that markets often overreact, driven by greed, fear, and the comforting illusion that this time is different. When Burry began examining mortgage-backed securities, the complex financial instruments built on home loans, he noticed something deeply troubling. Beneath the seemingly solid AAA ratings were pools of subprime mortgages, loans given to borrowers with poor credit histories, low income, and little chance of paying them back if the economy slowed. The deeper he dug, the worse it looked. Adjustable rate mortgages would soon reset, meaning millions of borrowers would face higher monthly payments they could not afford. What would happen when these borrowers defaulted en masse? The answer was simple: the entire structure built on those loans would crumble. But in 2005, few wanted to hear it. Imagine being the only person in a crowded theater shouting fire when everyone else is laughing and drinking champagne. That was Michael Burry. He didn't just have to see the truth, he had to stand by it, even when everyone thought he was insane. To bet against the housing market, he had to invent something that barely existed: credit default swaps on subprime mortgage bonds. In simple terms, he was buying insurance against the collapse of the US housing market. If the loans defaulted, he would make a fortune. If not, he would lose everything. To make this bet, Burry approached major investment banks, Goldman Sachs, Deutsche Bank, and others, asking them to sell him this insurance. They happily obliged, thinking they were taking easy money from a delusional doctor. They called him crazy behind closed doors. After all, housing prices had never fallen nationwide. Yet, as Burry later said, logic doesn't care about consensus. For months, he faced mounting pressure. Investors in his fund questioned his sanity. They couldn't understand why he was betting against something as safe as housing. The media painted a rosy picture, and Wall Street was still partying. But Burry refused to back down. He had read every loan prospectus, examined every mortgage pool, and followed the data to its inevitable conclusion. He knew the collapse wasn't a matter of if, but when. And so, as the world kept dancing to the music of easy money, Michael Burry prepared for the silence that would follow when the music stopped. What would you have done in his place? Would you have trusted your own analysis over the voices of billions of dollars saying you were wrong? This was not just an investment decision, it was a test of conviction, intellect, and mental endurance. The stage was set for one of the greatest financial dramas of the modern era, a story not just about money, but about the courage to see reality when everyone else is blinded by greed. By 2006, Michael Burry's position against the housing market had grown massive. He had purchased hundreds of millions of dollars in credit default swaps, essentially betting that the subprime mortgage bonds, the foundation of Wall Street's apparent prosperity, would collapse. But while Burry was certain about his research, certainty doesn't shield you from time. The collapse he predicted hadn't yet arrived, and his investors were growing restless. Every month that passed without a crash cost Scion Capital millions in premiums. The banks, confident they were on the winning side, gladly took those payments while mocking the man who was betting against them. Inside his fund, Burry faced a mutiny. Investors demanded that he unwind his trades, return their money, or at least explain why he was betting against what seemed like an unstoppable bull market. Some called him paranoid, others accused him of gambling with their capital. But Burry, ever the stoic realist, didn't budge. He had the data, hard numbers, not opinions. He had studied the structure of mortgage-backed securities down to their molecular level. He knew that most of these loans would default the moment their teaser rates expired. He didn't care about Wall Street optimism. He cared about math. Yet math doesn't soothe panic. His investors wanted results, not logic. By mid-2006, the pressure became unbearable. He stopped accepting withdrawal requests and temporarily locked investor redemptions. To the outside world, it looked like he had lost his mind. But what was happening behind the scenes told a different story. Burry noticed early warning signs. Delinquency rates on subprime loans were quietly rising. Mortgage companies that once gave loans to anyone with a pulse began reporting massive losses. Still, the market refused to acknowledge reality. Rating agencies kept labeling toxic bonds as AAA, and Wall Street analysts dismissed the trouble as contained. But Burry knew markets could stay irrational longer than most people could stay solvent, and that patience would be his greatest weapon. Then came 2007. The storm broke slowly, then all at once. Housing prices began to fall, mortgage delinquencies surged, and those safe securities that banks swore could never fail started to implode. The world finally saw what Burry had seen years earlier. The foundation of the financial system was built on sand. Suddenly, the very banks that had mocked him were now desperate to cover their losses. The credit default swaps that Burry had bought for pennies were now worth millions. Scion Capital made staggering profits as the market collapsed. His investors, once furious, were now ecstatic, but Burry felt no joy. He hadn't set out to destroy Wall Street, he had simply followed the truth where it led. While others partied during the bubble, Burry had spent sleepless nights analyzing documents, predicting the pain that millions of families would face when the inevitable happened. And now, it was happening: foreclosures, layoffs, financial ruin. Burry saw the numbers become human suffering. In interviews years later, he admitted feeling conflicted, vindicated intellectually, but saddened morally. He had been right, devastatingly right. Yet, for him, being right was never about ego. It was about clarity in chaos, logic over emotion. His strategy revealed an uncomfortable truth about markets. They are not driven by reason, but by emotion disguised as reason. Investors chase what feels good and avoid what feels painful, even if the painful path leads to truth. Michael Burry's story wasn't just about predicting a financial collapse. It was about understanding human nature, greed, denial, fear, and realizing that the greatest opportunities often lie in the moments when others refuse to look. The collapse of 2008 would make him a legend, but it also made him a warning. In every bull market since, the ghost of Burry's trade hovers, reminding investors that euphoria is just the first act before the fall. But even in his triumph, one question remained. What happens to the man who sees the end before anyone else believes it's possible? After the dust settled from the 2008 crash, Michael Burry became both a legend and an enigma. Hollywood turned his story into The Big Short, immortalizing him as the man who saw what no one else could. But behind that fame was a deeper reality. Burry wasn't chasing attention. He was running from it. In fact, after closing Scion Capital in 2008, he largely disappeared from the public eye. Why? Because the world still hadn't learned. The very people who had ignored him during the housing bubble were now treating him like a prophet, but few truly understood his message. Burry's insight was never just about predicting one crash. It was about thinking differently. He often said that markets reward those who can separate emotion from logic, crowd behavior from independent thought. That's what he called second-level thinking. While the crowd asks, what's popular? Burry asks, what's true? While investors chase headlines, Burry reads footnotes in financial statements. While others focus on quarterly earnings, he studies the hidden variables, debt structures, liquidity traps, and human psychology. After 2008, he didn't stop analyzing. He began to see patterns repeating, not in mortgages this time, but in other parts of the market. Low interest rates, massive government spending, and the rise of speculative tech investments reminded him of past manias. He warned that people were confusing stability with safety. When markets calm down after a disaster, they often lull investors into complacency. Burry understood that the seeds of the next crash are usually planted in the recovery of the last one. He started posting cryptic warnings online, often with just one word: sell. Sometimes it was about overvalued tech stocks, sometimes about cryptocurrencies, and sometimes about the broader market's blind optimism. The public's reaction was predictable. They mocked him again. He's paranoid, they said. Lightning doesn't strike twice. But history has a strange sense of irony. What made Burry unique wasn't just his intelligence, but his independence. He didn't care whether people agreed with him. In a world addicted to instant validation that made him dangerous and powerful, he didn't seek to predict the future. He sought to understand the present better than anyone else. He saw how human beings, whether on Wall Street or Main Street, repeat the same emotional cycles: fear, greed, denial, and panic. In one interview, Burry said something remarkable. Good investing is a little like being antisocial. It requires rejecting what most people accept as truth. That's why he often found himself alone. Not just metaphorically, but literally working late nights, isolated in his office, surrounded by spreadsheets and quiet conviction. To him, the market was a psychological battlefield, and the crowd was both the weapon and the victim. But what's fascinating about Burry's story is that even he admits he's not infallible. There were times when his timing was off, when his conviction cost him in the short term. And yet, he never lost faith in the data. That discipline, that unshakable belief in logic over sentiment, became the essence of his philosophy. Consider this. How many investors could hold a losing position for years while everyone calls them crazy and still believe? How many could ignore the constant noise of the market, the social pressure, and the fear of failure? That's what separates those who see the surface from those who see beneath it. By the 2020 seconds, Burry's perspective began to sound eerily familiar again. He warned about inflation before it surged. He criticized speculative bubbles in meme stocks and crypto assets. And once again, the crowd laughed until reality began to echo his predictions. He never claimed to know when the next crash would happen, but he understood why it would. The pattern was always the same: excessive confidence built on fragile foundations. Michael Burry's legacy isn't about being a doomsayer. It's about being a realist in a world addicted to optimism. He reminds us that markets are mirrors of human emotion, and when the reflection becomes too euphoric, the mirror eventually cracks. His story asks a haunting question. Are we doomed to repeat the same mistakes, even when someone warns us in advance? In every generation, there are a few who see the truth before the crowd does. Most are ignored until it's too late. Burry's gift and curse is that he sees the cycle not as numbers, but as psychology. And in that, perhaps, lies his deepest insight, that the greatest risk in investing is not the market itself, but our inability to think independently. Because, as Michael Burry has shown time and again, the crowd isn't always wrong, but when it is, it's disastrously wrong. And in those moments, it takes one person, standing against everyone else, to remind the world that logic is not madness, it's courage. In the years following The Big Short, Michael Burry's legend evolved from that of a contrarian investor into something much larger, a symbol of intellectual defiance. He became a figure studied by hedge funds, business schools, and retail traders alike. Everyone wanted to know, how did he see what no one else did? But to truly understand Burry's vision, one must look beyond the headlines and into his method, his mindset. Burry wasn't driven by luck or instinct. He was driven by process. He immersed himself in data until the noise faded away and the truth revealed itself. He read thousands of pages of mortgage documents line by line, hunted for irregularities, and found what the rating agencies ignored. That obsession wasn't just analytical, it was philosophical. It came from a belief that truth exists even when no one wants to see it. That same philosophy guided him after the housing collapse. When others sought comfort in easy profits and speculative trends, Burry sought discomfort, the places where fear lived, where everyone had already given up, because he understood that value hides in neglect. As he once said, all my best ideas come from finding something ugly that no one wants and realizing it's beautiful underneath. In a strange way, Burry's story is not just about finance, but about human nature. It's about how societies fall in love with illusions and how one person's clarity can expose an entire system's blindness. Think about it. During the mid-2000s, some of the smartest people in the world convinced themselves that housing prices could never fall. It wasn't just greed that blinded them, it was comfort. It's always easier to believe what everyone else believes. But Burry had no interest in comfort. He preferred discomfort, the solitude of being right too early, the sting of mockery, the isolation that comes with conviction. That's what separates great thinkers from the crowd. They don't seek validation, they seek accuracy. They don't measure success in popularity, but in truth. Today, Burry's warnings echo once again. He's questioned the sustainability of debt-fueled growth, the distortions created by central banks, and the speculative frenzy of retail investing culture. To many, he sounds pessimistic. But perhaps it's not pessimism, perhaps it's realism in a time of delusion. After all, when everyone is optimistic, the rational voice always sounds negative. So what can we learn from Michael Burry's journey? It's not just about predicting a financial collapse, it's about how to think. He teaches us that true investing and true wisdom comes from skepticism, patience, and courage. It means questioning the assumptions others accept without thought. It means having the discipline to dig deeper when the surface looks shiny. In investing, as in life, the crowd often moves in herds, and herds, by nature, run toward cliffs. Burry reminds us that being early is painful, but being wrong with the majority is deadly. His approach forces us to confront our own biases. How often do we buy something because it's popular, rather than because it's valuable? How often do we confuse movement with progress? How often do we silence our doubts because everyone else seems certain? There's something profoundly human about Burry's story. A man with Asperger's, introverted and uncomfortable in the spotlight, becomes one of the few who sees through the illusion of $1 trillion system. His strength wasn't charisma or charm, it was clarity. It was the ability to stand alone in a room full of experts and say, "You're all wrong," and be right. That kind of courage is rare not just in finance, but in any field. And that's why his legacy endures. Because in every era, there are bubbles of markets, of ideas, of beliefs. And in every era, there are voices warning us to look deeper. Michael Burry's life asks us to become those voices, to be unafraid of doubt, to seek truth in data, and to embrace the discomfort of being different. So as we close this story, ask yourself, when the next storm forms on the horizon, will you follow the crowd into the noise, or will you step back and see what no one else is seeing? Because the next big short might not come from housing, or tech, or crypto. It might come from the same timeless source that has always driven human error: overconfidence. Michael Burry reminds us that the future doesn't belong to those who predict the loudest, but to those who think the deepest. And in a world that rewards speed, speculation, and conformity, his quiet defiance stands as a timeless reminder that real power lies not in following the trend, but in understanding it before anyone else does. And that's the story of Michael Burry, a man who dared to see what others ignored and proved that conviction matters more than consensus. If you found this story inspiring, make sure to subscribe for more deep dives into the minds of legendary investors. Stay curious, think independently, and remember, the best investment you can make is in understanding.